it.
All right. Hello, everybody. Welcome to Friday. Sorry for the delayed start. This is a live show with all kinds of fun things that can happen to us. This is Ask Talk Money with Tom.com. And what we're doing here is just a Q&A show. And we do this every Friday from 12:15 to 1 o'clock. And we're just trying to, help people increase their net worth in order to be able to, um, uh, find out more and more about the topics of financial planning, tax management, and investment management. And so what you want to do is just send in your questions to Ask Tom at talkmoneywithtom.com, and then be able to have that go to Katie, who's here on the show also. She'll be our moderator. And so Katie will be asking the questions and then maybe asking some follow-up questions. And then Eason, who's also here on the show, one of our advisors, he'll be asking some follow-up questions just to kind of build the questions out. And then, of course, you can ask Eason a question directly if you'd like also. So really fun. We enjoy this process a lot. And if you want to, find out more of the information that we're posting on this channel, you're going to want to subscribe to the channel, the little subscribe button. And if you want to get notifications, you'd hit the little bell right next to that. You get notified when we put stuff on the channel. And if you don't like to subscribe to things like that, maybe you just want to get an email with a link to some of these videos, you can join our email list and just send in your email to asktom at talkmoneywithtom.com. And we'll send out, I put out an email every single day on, what's happening in the market as far as I'm concerned. And then also, what's happening with the overall, investment and financial planning arena. So we usually send out another link to another video that we posted that day. So two different ways, to keep up with what we're doing here. And so again, feel free to send in your questions as soon as you want, and we'll get rolling on that. So uh, for starters, what I'm going to do is talk about the market as a whole, kind of a summary for the week. But I'm going to do something a little bit different. About once a quarter, I do what I call Positive Friday. And so on Positive Friday, what I'm trying to do is show all of the things that I think are good about the stock market, why you would want to be an investor right now in the stock market. One of the things I've noticed over the years is that negative news sells better. So there's all kinds of articles and information out there about why you shouldn't be an investor in the stock market, or why the stock market is going to crash, or all those things. And so I'm just trying to create a counterbalance. It's not that I'm ignoring the negative side of the market, but I do want to show you all the positive things. And I don't know that they are all emphasized enough, in my opinion. So I'm just going to start with a little, sharing of my screen here and show you, some of the things that I think are important. So first of all, one of the issues that's really happening is the fear of inflation has been making the market very volatile lately. And this is a chart that came out of a Market Watch article just showing the top 5 price increases from April to May. And these are big numbers, rental cars up 12%, used cars up 7 just for the month, airline fares, etc. The overall was up 0.6, which is again a big number for a 1 month piece. So lots of fear about hyperinflation coming and those types of things. But when you really dug behind this, you started to realize that a lot of these were sort of short-term anomalies based on the fact that a lot of companies just weren't ready for the surge in demand that came because the vaccine, at least here in the US, came out so quickly. So, that's a good thing. And so what's happened here is, we started to see some of these prices increases slow down, and that's a good thing. The one big thing that you really got to watch out for, in my opinion, in inflation, I think is doing okay, and that's average hourly pay increase. So this chart shows, back at 2019, every 12 months, year over year, the increase was around 3.6% a year. Then we had this big spike in average hourly pay because a lot of people that were lower paid got laid off and the white collar stayed. So that jumped, kind of an anomaly, dropped again, sort of an anomaly. Now look at where we are. We're right back where we were in 2019. So this is something to watch, but right now, the wage increases that have happened are average for what we were seeing prior, when 2019 was a really good year for the stock market also. So I think that's important. That's the key piece that you look at for inflation, in my opinion, is labor. Now, the other way to look at this is a chart of the 10-year treasury. going back to the end of 2018. And so you can see it was around 3% back then, and it dropped. And then we had a big drop due to the pandemic as they lowered rates. And it got down to a record low here, 10-year Treasury, about a little over 0.5%. But what happened after that scared the market because it went all the way up to 1.75. And so we had, a reopening, the vaccine rolling out, we had stimulus bills coming out, we had talks of infrastructure and family plan, and it really scared the market like too many things. But what you've seen now, though, in that since that peak, is the bond market's coming down. Again, that is, if you're going to look at one thing that is a signal for future inflation, it would be the yield on the 10-year Treasury, in my opinion. And so anyway, this is moderating. It's better. Again, in this scenario that we're in right now, I think that's a positive for the stock market. And we are seeing a really good market today. And I think part of that is because this fear is reducing. I think this is maybe the biggest threat, is this inflationary threat. And I think it's okay at the moment. Then there's this government spending, and these charts come from the Wall Street Journal, and these are the proposed American Jobs Plan, otherwise known as the Infrastructure Plan. So we've got all of this money that's being proposed to spend, and again, this might change, it might not even pass, although I do predict that there will be some type of infrastructure bill that does get passed, and because there's a lot of public support for this. But so we're looking at transportation and money coming out for highways and roads and electric vehicles and et cetera. Here's manufacturing, domestic. They've already passed a bill actually in between times here on the semiconductors, clean energy, small business money, jobs creation and research, National Science Foundation, all climate technology, et cetera. And then the last one is, housing, buildings, utility, affordable housing, high-speed broadband, improving our power grid. That'd be awesome, honestly. So these are all things that, if they come to be fruition, even in smaller dollar amounts, would be stimulative to the stock market, okay? And one of the things that the market was scared of was that this is going to be too stimulative, was going to be too hot. But they are talking about spreading this over 8 years now, which I do think it would make it less likely to cause a hyperinflationary event with this money coming out. But this could be a really good thing. So the next subject that's kind of a threat is the virus. This chart with all these crazy colors comes from BlackRock. And so what they're showing here is the number of cases per country, per week, per million. And so you can see here in the US, for example, we got down to 35 cases, but it's coming back up. You see here in the UK, it's coming up in Spain, Netherlands, Belgium, right? Denmark, Ireland, Russia, South Africa, etc. If you look at most of these in the last week or two, you see some upward movement. And so this is the big fear right now, is that the Delta variant's coming back, everything's going to close down again, and we're going to end up, in this scenario like we were before. But there is a solution to that, and that is the vaccine. So here's the vaccine, total vaccination percentage of the country for every 100 people, basically UK, US, Germany, Italy, and France, for example. What I really want to point out here is just look at the trend. It's up. And so we're hearing a lot of news about how people aren't taking the vaccine. It's still up. I mean, you can see here in the US, it's kind of flattened a little, but it's still up. And so the solution to this big Delta variant that's coming out will be more vaccine development and more distribution of that. And I'll give you a great example. This is another chart from BlackRock. This just shows by country how many people have had one shot, and these red dots are how many people have had two shots or are fully vaccinated. And you can see, it's actually pretty good. There's a whole bunch in here, but I'll point out Australia, because a couple of weeks ago when I looked at this chart, Australia was at about 8%. And then they had some Delta variant cases come and they locked down, and lo and behold, now they're at over 25%, at least with one shot. So again, there is a solution for the variant right now. So we'll see how this plays out. It's something to watch for, there's no doubt. But I think that this is supportive. And I think looking forward, the vaccine is one of the reasons that you might want to invest, because it seems to be working and it is getting distributed pretty well. Maybe not as fast as we would think or like, but it's happening. Now, what happens there, and this, I call this stored energy. This is another piece to look at. Just how much are people moving around versus how much they were moving around before the vaccine hit. And you can see this big squiggly line, and they're looking at cell phone data and how much it's moving. And of course, everybody stopped moving, quite a bit, down to negative 70%. So they're moving 70% less than they were prior to the virus happening. But if you look here most recently this year, almost all of these trends are up, right? And so there is people people are starting to get back out, starting to move, and I equate motion with economic potential growth. So, the more people are moving around, the more international travel we have, the more they're going to restaurants, the more they're driving to work, and all those types of things. Those are all potentially economically stimulative events. And this shows by country, essentially, the activity. So let's take a look at the US here. The US is basically negative 20%. So it just means that here in the US, we're moving 20% less than we were prior to the pandemic. This line here is February of 2020. This is stored energy, right? This is not in the economic numbers right now. When this moves over to the other side, and I think it will, I think once you pent up people and let them out, eventually they'll start to move around even more than they were before, once people feel more safe. And so this is potential. And this is potential growth in the economy, which would equate to potential growth in the stock market. So again, I think that's a good thing to look at. I showed this last week. This is gross domestic product, right? So this is the overall kind of production of the country. And again, we see the big drop here. And then look at, we're above where we were, but look at the trend, very strongly up all the way through from this low point and continuing up. We are doing really well on gross domestic product right now. And here are the number of job openings, high record, 9.3 million job openings, unbelievable. And so I think that's important. That's potential growth as these jobs start to get filled. And I showed this chart from basically the Wall Street Journal last week. It just shows the number of jobs that were in February 20, how much we lost. And look, we're gaining them back. Okay, so that's important. I think that's an important component. We're seeing fairly consistent growth in the job market, but this is also stored energy. There's still 6.8 million people that are unemployed. Eventually they get out there and start to work. That creates more money for the market. And we're able to do the same gross domestic product without those people. That's high profits. And I think that'll just continue as this workforce comes back into play. All right, cryptocurrency. I think people aren't paying enough attention to cryptocurrency and how much impact it's having on the stock market. So if you look back here, this is the last couple of years, really strong growth, peaked out in May. Well, now it's falling. That's a good thing for the stock market. If people aren't buying crypto and they're selling crypto or not interested in crypto, they might start to take a look back into the stock and bond market. And we have seen some increases in a lot of the areas that did well last year prior to this big cryptocurrency run for the beginning of this year. I mean, this is just 2021. This is called the CMC Crypto 200 Index. This is the top 200 cryptocurrencies by market cap weight. This is a cool little index to follow. So again, that's a positive for the stock market that it is falling, because I think that is a distraction from investing in the stock market. And then last piece I'll show you, and probably the most powerful piece if you pay attention, this is the Fed funds rate. This is how much the Federal Reserve charges banks, and this is what they set, and this is what they're always talking about. And if you look right now, we're basically at zero, all right, for the Fed funds rate. But these little gray pieces going back to 1955, they're all recessions. And most of these recessions equate to stock market downturns. And some of them are huge stock market downturns, like we saw here in 2000 and 2008, for example. But look at the pattern here. How many of these gray recession periods happened when interest rates were going down or were low? None. Look at everyone. Up, Great Recession, up, Great Recession, up, Great Recession, up, Great Recession. Maybe you could make an argument there, a slight argument there, but mostly it only happens when interest rates are increasing. And so right now we're super low. They're talking about increasing rates in 2023. So that's making some problems for the market. It's worrying about that. But look at the numbers and look at the facts. So go back to 1995. So rates were low. They started raising rates, and then it went sort of sideways, and then they raised them again. And then finally we ended up with roughly a 45% drop in the S&P 500. But this was 19 increases before that happened. And so if you really think about this, that was the best 5 years in the history of the stock market. We're not going to see a massive crash right away just because they're going to raise rates in 2023. So this is one of the more important pieces when you're looking at the market, is what's happening with the Fed funds rate. And the market's going to get volatile as it worries about it happening and increasing rates. And we also have these bond purchases that they're doing. It's going to be very hard for the Federal Reserve to navigate this scenario. But in terms of big downturns, we're probably a ways away just looking at this chart. So anyway, that's what I think is happening altogether. Really fascinating time frame right now. Lots of positives that could be grabbed onto. Again, I don't mean to ignore the negatives. I think they're super important. You got to look at all of them. But I want to be a resource here for some of this, for what I see as the positives. And honestly, I don't see anybody else even covering these things as a whole. So that's what's going on. And now let's switch over to, the Q&A session. So hopefully there's been some questions have been sent in while I was rambling along there. Anything come in, Katie, that we should cover?
Yeah, so we've just scratched the surface of this question just a couple of times, but never really taken an in-depth look. So the question is, what are the best steps to get income for my retirement?
Oh, okay. That's a good question. It's the key aspect. I remember, I had a client one time said, I want to, go to school for 25 years, work for 25 years, and be retired for 25 years. That was his big goal. So, but actually, retirement is longer and longer and longer, because life expectancies are getting longer. And so, you got to have money coming in some form or fashion to pay your bills, almost no matter who you are, there's got to be something there. So, income generation is really, really critical. Actually, let me share something here. Let me find, hang on a second, and I'll share it. I'll just share something on our website that you might be able to go look at yourself too. So this is our website for retirement capital strategies. You go to this helping you retire. And in here, we have this thing called the retirement income builder. And so what I'm trying to do here is just kind of, for starters, identify every possible place that you could be generating income for your retirement. So stock and bond investments, right? Savings and CDs and the interest that you get off of that. Annuities, there's lots of different versions of those. Those are possibilities. Alternate investments like commodities and, those types of things. Of course, Social Security. Now, this is a really big area. How do you maximize your Social Security? And there's a lot of room for planning in this particular area. Pension, same thing. Do you have a pension? How do you maximize that pension? Which options should you choose? Are you a landlord? So in other words, you get rent. Do you want to get rent? Is that some place you'd like to go, during your retirement? Or are you investing in mortgages? So this is where you're lending somebody against their home, and you earn interest on those. Will you use your home equity in your retirement? So I have, clients in 26 states outside of California now, partly because people have sold their houses here and bought someplace less expensive, and they've kind of captured that differential, and they're investing that usually in the stock and bond area. But you can also look at reverse mortgages. Most of the times it's not the best concept, but it's not a terrible thing if it's the only one you got. But home equity is definitely something to look at. And then business or work. An awful lot of my retired clients have continued to consult or started small businesses, and they're generating income there. So I think for starters, you kind of want to take a look at this, retirement income builder concept and look at all of the different areas and figure out, which ones you really want, where you'd want to go with those, and then, how to make them work for you, in a really good way. So for example, this is one of the biggest areas where we see income generation in stock and bond investments. And what we do is what's called a systematic withdrawal. So we'll create a balanced portfolio, let's say a 60-40 portfolio or whatever it is. And then we'll have a piece that's in the money market, and we have money coming out every month at money market. And when it gets too low, then we rebalance that. And so we're kind of relying on the interest and dividends and the growth of that overall portfolio to support that distribution. We've actually been doing that for 35 years, and it's been quite successful. And so, every one of these is different things, but you definitely want to try to maximize your potential here, even if you don't think you need it, because in case you do, at some point in time, it might be kind of difficult to, really get to a spot where you can, make sure that you have enough income. And that's looking at that wheel and figuring out all of the different ways that you can maximize income out of that wheel. That retirement income builder program is very, very powerful.
So, do a lot of people like already when they hit retirement, do they have a lot of these things, or is it too late to try and add a different income stream when you hit retirement age?
Now, that's kind of the beauty of it, whether you're 20 or 80. For the most part, all of those areas that we talked about, stocks and bonds, CDs, annuities, alternative investments. I don't know, maybe, when you're 80, you don't want to go running out buying a rental property that you've never done before, or something along those lines. So there's some criteria there, but no, I would say age isn't so much of an issue. It tends to be more just personality pieces. I got people that love rentals. I got people that would never do them. That's just something that you kind of deal with. The annuity area is so wide open. There's so many different options. Some of them are probably really good for certain situations. Some of them are really bad. So you have to be just, know what you're talking about and know what you're dealing there. But no, I think, you could do any of those even if you're 20. You can start picking. Now, usually there's a limited resource. You don't have all the money in the world to go after every single area. So you probably want to build up, in certain areas first. And as those get bigger, maybe diversify into some of these other income production areas. But really, really smart retirees have quite a few different possible areas that they're going to get income from. And they just, because that's Social Security, maybe they got a little pension, maybe they wrote a book and they're getting royalties on. I mean, it's just amazing, all the different ways that people can generate income. And I really like a diversified income plan as a whole. I think it's really robust.
We had this huge ransomware attack. I'm interested in investing in cybersecurity. What is the best way to do that?
Yeah, that's a good question. Actually, we have been investing in cybersecurity. So there's a couple of different things that I would say there. First of all, the cybersecurity industry is fairly fragmented. It's really powerful. They're making some unbelievable tools. There's hardware, there's software, there's a whole bunch of different ways that you look at trying to protect yourself from a hack or these ransomware situations. And because these things are happening and they keep happening, and we've had some really big ones, the one that's happening right now is $70 million, maybe 1,500 different companies involved. We're starting to see a lot of interest in cybersecurity stocks. So, number one is I would be looking at ETFs as a whole in that arena just because I want to buy all of the cybersecurity stocks. I don't want to try to figure out which ones are going to be the big winners here because it's a little fragmented. A lot of them are a little bit smaller as far as that goes. And so there are not a tremendous number of ETFs that specialize in cybersecurity. I think there's 7. 3 of them are real new. One of the other 4, one of them's kind of having some trouble. So there's basically 3. We use 2, and we've had one called iHack. That's the ticker symbol. That's the iShares Cybersecurity. This is part of their Megatrend portfolio, where they've identified some major trends that they see happening in the future. And cybersecurity is one of them. It's just continuing. You can see why they picked this as a megatrend with these ransomware attacks that have happened. And so that we've had since last April, I'd say, in the portfolio in some different form or fashion. And then recently we purchased BUG, which is Global X's cybersecurity piece. It's a little narrower, a little bit more, focused on that cybersecurity. And that's done pretty well for us so far. I've actually been pretty happy with that. Even like in a down day yesterday, for example, it kind of held up a little bit better. Still came down, but there's a demand for these cybersecurity companies, and I believe that they'll continue to see their revenue growth because these guys are making a lot of money. They got $5 million out of that Colonial Pipeline piece. Some of that they got recovered, but $11 million from the meat packing plant. Now they're asking for 70 million. And these are just the ones we're hearing about. So there's probably lots of little ones too. They're not going away. And so companies are starting to look at this and say, hey, this is a mission critical piece. We've got to focus on, getting our things under protection. So I would look at Bug and iHack as 2 pieces to really consider for cybersecurity.
Yeah, another thing about cybersecurity is it's not just the public sector or the private sector, it's also the public sector.
Yeah.
Militaries need and like the government needs the
Yep.
same kind of cybersecurity. And so you have spending across the board.
Yeah,
National
that's a good
defense
point because
is
government contracts can be quite profitable. They usually have, really stringent requirements and what have you. Yeah, yeah, yeah. I guess another way to look at that too is you've got governments and companies with a lot of money to spend in this area because they have a lot to risk. And so you got these small companies who could get big revenue. And the other thing about cybersecurity that's really fascinating to me, it's not just like, your computer, it's everything. It's Internet of Things, they call it, IoT, Internet of Things. And so everything's kind of connecting. So in 2018, somebody hacked into the thermometer of a fish tank in a casino. And then they managed to work their way through into the high roller database. And so who would have thought, right? So every single thing that you have that is connected to the internet might need some type of cybersecurity protection. That's a big market. Big companies with lots of money, the government, and all the little things. It's a huge market. Somebody's going to make a fortune off of this whole area. So, and that's why you want to maybe invest in that area, and that's why we have it in our portfolio.
So Ethan, we have a question in for you asking, I inherited a decent amount of money. How should I allocate it?
So, first thing I would do is slow down. You don't want to make any rash decisions. Like, if you got enough money, you quit your job, buy a new Ferrari, and just go into the sunset. Fortunately, not all of us can do that. And so I would start with a plan. What are your goals? And if you don't have a plan, maybe you need an advisor to help you through. Are there any tax implications? What's your investment strategy? Are there any adjustments you need to make to your insurance or your estate plan? And so some of the first things that most people do is you can kind of pay down those high interest debts, credit cards, any kind of existing high interest student loans, and top up your emergency fund. And then you can start allocating some of your money for kind of your goals. But remember to also live a little bit and have some fun with your money.
Yeah, it's interesting too because I handle a lot of inheritances over the years. Kind of depends on how much, so if it's a small inheritance, it might be a totally different plan than if it's a big inheritance. You might spend a small inheritance on some lifestyle things that you're really interested in, but you probably shouldn't do that if it's big because that could, really set you up for the rest of your life. Also depends on what you inherit, right? So if you inherit IRAs in today's world, for example, those are great assets and there's usually some good money in those, but you have to take it out over 10 years. So then you get into a whole tax planning category too, which is really interesting. Um, because when do you take it out and what's the best way? And again, if it's small it might not matter, but yeah, hey, I just inherited $1 million IRA. Wow, you better really think about how you're going to get that money out of there, to try to reduce taxes as much as possible. So there's some different pieces that are very fascinating about inheritances as a whole. And it's unfortunately 4 out of 5 people in America have spent their entire inheritance in 5 years. That's the average. And we've seen that some in our practice, some crazy things that have happened. Uh, you know, and I remember a guy flying in from Colorado, was the son of a client, was coming into our lobby because he just put a down payment on a Corvette and he needed the money, and it's kind of, we're not a bank, we don't have the money. It's not sitting there, he wasted his trip. It's the paperwork has to be filled out, so, obviously his plan wasn't, financially sound, probably. I don't know how much money you can make on a Corvette unless it's the right one, but anyway, for the most part, we see a lot of really intelligent things happening within our clientele. Our clients are really smart. They're really, really good with money, and it's why they're, have the wealth that they have, and they've passed that along to their children, which I think that's the best inheritance you can give your kids is how to handle the money. And that's a huge issue.
How often should I rebalance my investments?
Mm.
What are some ways to do it?
Yeah, rebalancing is a really interesting area. If you look at Vanguard, they basically claim, rebalancing is irrelevant as far as that goes, doesn't create much difference. But if you look at BlackRock, they did a big study, and matter of fact, they just posted that last year, where when you get 5% out of balance, so let's say you're 60% stock, and you're at 65% stock. And so they use just basically a broad category, stock versus bond. And they show a much better rate of return rebalancing every time you're 5% out of balance. So as a very simple rule, that's pretty easy to remember. And so, if you're at 55% stock and your target's 60, then you would rebalance and sell some bonds and buy some stock, right? And that actually seems, I like that study. I read through that pretty in depth. Then in the late 90s, they had a thing called opportunistic rebalancing, and there's been quite a bit of follow-up on that, and it seems to be very promising also. And that's where you put bands around every position of your portfolio. And so you maybe have what's like a 20% band. So for example, if I have a 10% position in my portfolio, I would let it go plus or minus 20%, which would be basically, 10% could go to 12, right? Or 8, right? Plus or minus 2% is 20% of 10. So now, if it gets to 13, I'm going to rebalance that piece and move it back to 10. And that obviously is going to someplace else that's lower. Or if it gets to 7, below 8, boom, I'm going to rebalance and buy some. And opportunistic rebalancing is actually very effective. And you kind of look at that. You can go in and look almost every single day and watch for that to happen. And you're, instead of doing something, random like once a quarter or something, you're actually able to do that. And we've been doing that since the late 90s, actually, since that came out. And I think it's very effective, actually. So, there's a lot of different ways of looking at that, but that's kind of what I know about rebalancing.
So how would you rebalance for like a 401k? Because instead of selling, would you just change how you allocate your contributions and just adjust your allocation or your contributions and
Well,
have it still top up?
401ks are interesting because let's say I have a target and the target starts to float away, right? So I'm 60% target and now I'm at 58% or something like that. Well, one of the things that's happening is every time you're adding new money, you're still adding at that, hopefully that same percentage. So your new money's coming in with 60% going to stock. And so what you'll do with new money coming in, you probably don't need to rebalance because you basically are rebalancing every single time that purchase. You're pushing money back towards that one area. Now, I'd still look at that, at least the 5% rule. So, because that can happen, even because the market can overwhelm, especially if you have a bigger 401k, it can overwhelm your contributions. And so if I got down to 55% stock, I'd just go in and redo it and push the money, manually to get it back to 60, and then should stay there if I'm continuing to put it at 60 or whatever percentage it is. So yeah, that's an interesting case study because there is new money coming in on a regular basis. Generally keeps things in balance. But yeah, not always.
I'd just like to take a quick moment to remind our viewers to please hit the subscribe button. Your support means so much to us, and it's never too late to send in any questions to asktom@talkmoneywithtom.com. So we do have another question in asking, what are some common expenses that you see in retirement that everyone may not be aware of?
Oh, yeah, that's actually a pretty common question because, it's one of the things we all worry about. We get to a certain age where we can't get a job and, we're now living off of this income sources and our assets. And is there something we're missing, something we're not thinking about that isn't in our budget? What kind of surprises can come up in retirement? So one of the things that we always talk about is the cost of medical care in general. And I'm going to ignore long-term care for a minute, just regular medical care because I think it's the Employee Benefit Research Institute has a big study out saying that the average male throughout their retirement will spend 144,000 on medical costs. This would be deductibles, drug costs, all of these things. The average female pays 163,000 again, mainly because they live longer, and the average couple pays 301,000. So that's a big number. Now this is over a lot of years for the entire retirement. But if you ignore that completely in your planning process, that might be a big surprise. So I would definitely look at that kind of basic medical cost, make sure that that's in your plan and that you have some, thought process on how that's going to work. Long-term care is obviously one that a lot of people do talk about. And it's not particularly a surprise, but having some type of a plan and testing your plan against long-term care, should you have insurance, and if you do have insurance, is it enough, those types of things. So that's a big issue. Housing, I just had my house blow up on me yeah, basically a leak in the wall and created a huge problem. Most of that was covered. Now, so one of the things that I would look at is insurance. Had a client had, the '89 earthquake, their house basically almost split in half up in Felton, and really, really wrecked her financial plan. The house isn't worth anything when it's at damage. They did declare an emergency, and she was able to get a low interest rate loan, but she still had to pay it back, and it was a huge deal for her. So would have been nice to have earthquake insurance. I know a lot of people don't do that, or flood insurance and those types of things. I tend to have a lot of insurance personally, and I look at it a little differently than some. you know, if I go to Hawaii, I'm going to spend X amount of money to go to Hawaii, and it's my vacation, and I'm going to get a certain amount of enjoyment and some, feel more relaxed or whatever it is. By having a lot of money going out to insurance policies, I feel the same way. It's like going on a vacation. I feel like I've got everything covered. So when my house did blow up, it cost me some money because I do use high deductibles because I believe in that. I think that, I'd rather have that high deductible and lower payment per month for something that might not happen. But those are types of things. I guess the last one that jumps out at me is kids. Different emergencies that might happen to kids or grandkids, or even not emergencies. Trying to help your kid buy a house wasn't really in the plan. All of a sudden, there's a bunch of money going out to help them with the down payment. So, if you have kids, that's always a possibility. Some of those things that you should back test. Hearing and dental, we put in every plan now because most times that's not covered. So some amount per lifetime for those two areas, for example. So anyway, those are some of the major ones that I can think of.
Yeah, I think you covered all of them. How when do people usually lose their hearing or need new or new dental work done? Is it like in their like 70s, 80s?
Yeah. Well, it's obviously variable. It depends on the person. We do put it into the plan in kind of that mid 70s to mid 80s time frame for both of those. On average, I'd say that main reason we put those in the plan now is because we kept getting calls. Hey, I've got this bridge that I need to put in. It's going to be $5,500, or I need these hearing aids. They're going to be, $7,000 or $4,000, whatever. So after a while, we were like, okay, this has got to be something that's in the plan because we just kept getting calls for, the money that was being spent on those. Obviously, not everybody needs either one of those. Kind of depends on what happens, but that is something we put in the plans now.
Yeah, so like when for hearing aids, doesn't Medicare usually cover that kind of stuff, or is it kind of like the better hearing aids you have to go out and spend some money?
Yeah, it depends on the Medicare plan that you have, whether it is covered or not. I still have clients that want something else. So in other words, even if it is covered, they go and look at what that is, and it's not what they want, and they want something better, and so they end up paying out of pocket for that. So, yeah, what's covered? Some people use it. Some people aren't covered for it, depending on their Medicare plan, and some people just basically want an upgrade for what is covered. So, I mean, I had a division plan that would cover certain things, but they're not glasses I would wear. So I always had a lot of out of pocket, money for the glasses that I actually wanted.
So we have a question in here from Woody, one of our top fans, and wanted to give him a huge thank you for always sending in so many great questions. And one of the questions we have in is he would like to know if criminal instance on cryptocurrency payments will have any effect on these network attacks.
Yeah, that's actually a really interesting area, right? Because one of the things that's happening with all of these ransomware attacks is they're asking for payment in cryptocurrency. And so, that does give a certain amount of kind of, oh, I don't know, an illegal sheen to these cryptocurrencies, which probably doesn't help their, adaptation, which would be critical if you're looking to make money on cryptocurrencies. Uh, what was really fascinating was in that ransomware attack where they attacked the Colonial Pipeline. They Colonial contacted, the Justice Department before they paid, and they were able to track the Bitcoin payment, and I think it was 5 billion, and they got back 4 something. And That's not supposed to be able to happen. One of the reasons that they like to use those things is that they're basically untraceable using this blockchain methodology. But between the Department of Justice and the FBI and the NSA and what have you, they figured out a way to track that. Sort of like putting a dye pack. You know, when somebody robs a bank, they put a dye pack and it blows up. And hey, that guy that's red or blue or whatever is your bank robber. They were able to track that. I think that probably creates a problem for cryptocurrency, just in the sense that if you were going to use it for a criminal enterprise, now you got to kind of wonder, are they going to be able to get it back? And they did in that particular case. So, I'm not positive how that works, but it does have an impact. It is something I actually think people aren't paying enough attention to cryptocurrency in this particular environment. They need to. Not from a really scary standpoint, but it does have an impact on what's happening with the stock market. And so the more you can understand about cryptocurrency, I think, again, the object is increasing investor education. I would recommend that you start to look at what's happening in cryptocurrency, even if you're never going to buy it. And understand what's happening there. That one index, that CMC 200, I mean, I look at that every day. And so I think that's important to see, what correlations are happening. And when that runs, what's not running? Where is that money coming from? So yeah, all of that, the legal aspect of it. Bitcoin's taken a big hit because it takes a lot of energy to mine it, which is a whole nother subject, but they're working on some of that. But yeah, anyway, there's a lot of pieces that go into that, but it's a good question.
Yeah, and especially with crypto, there's a lot of speculation that there'll be incoming regulation. China, U.S., all those countries want to regulate it in some fashion. Like I remember recently, one of the U.S. senators said that they want to make crypto transactions reversible, and that would be a very big deal because it goes counter to what people in crypto believe.
Yep. Yeah, it would take away the whole thing of crypto from a criminal standpoint if they could reverse the transaction. Because supposedly, prior to this colonial pipeline thing where they got some back, the blockchain is supposed to make it almost impossible to which is the technology that they use to basically hold on to the crypto. It's supposed to make it impossible to track, and yeah, they did it. So yeah, that's a good area. The whole regulation aspect of it will be very fascinating.
Well, Tom, I wonder if you've heard your market bell ding yet.
Yeah, we started so late. I thought we'd go, we started about 10 minutes late because we had technical difficulties. I apologize for that. Is there one more question that we might take?
Sure. We have one more asking, I have so much money to save. Should I be investing for retirement or college education for my kids?
Okay. That's a loaded question. So basically what happens for most people, there's a limited amount of money to save, right? I mean, not for everybody. Some people have money for everything, but for most of us, there's some choices we have to make. And so this comes up a lot. Hey, I'm in my 40s or 50s or whatever, and my kids are going to hopefully go to college, and should I be funneling lots of money into college savings and not doing so much in my retirement plans, or vice versa? Now, I've read a lot of articles, and almost every article says, oh, you should be doing money into your retirement plans at a much higher rate than you would do into college savings. Well, I looked at some of those authors; they don't have kids, so I have kids, and they're my number one goal. That's what I do. Everything I do, I'm here today because I want to make sure that they're taken care of. But and I had a weird experience growing up personally where my parents were really into college. They both went to college. They took us to all these colleges when I was growing up and got really excited. I got into some great colleges. And when I was 17, I found out that they didn't save anything at all for college. So I ended up having to pay my own way through San Jose State, which there's some benefits to that. Partly maybe a reason I'm here, but I didn't want my kids to do that. So there's this, competing pieces, and it's emotional more than analytical, in my opinion. And so what I recommend is actually kind of a bifurcated approach, where you would do three pieces. Number one, you would make sure, if you're going to contribute to your retirement plans, if you have a 401k with a match, get the match. I mean, if that takes all of your savings, then that's the way it is. Then just try to work towards more savings in the future. So if the company's going to match up to 3% of your salary and you put in 3%, you're getting 100% rate of return on your investment. That you can't beat that. You got to do that. It's too important to miss out. But in a perfect world, you'd put a third of your savings money that you do have available into your 401k, a third into a 529 plan, which is a college savings plan that has some flexibility. You can change which child gets it. If you don't have a child, that one child doesn't go and the other one does, or what have you, you could use it for your grandkids. It's got some, it grows tax free as long as you take the money out for college. And then I'd put a third into just a regular account, a joint account or a trust account, where, you know, if the child went off to college, you could use that. If they didn't, then it's for your retirement. Because a lot of people don't have enough money outside their retirement accounts in retirement, and it creates all kinds of issues. So you'd want to have that anyway. And if you did need it for college, then it's there. So I think that's the best way to kind of balance it, is like a third into retirement plans, a third into college plans. I would recommend a 529, and a third into just a regular account. We call it a taxable account. There's pros and cons to all of those, but then when you're kind of evenly distributing your savings into all three, I think that's a good strategy.
Yeah, and a lot of people, when they, after their kids go to college, is kind of their peak accumulation period, where they have the highest income and essentially they have the lowest expenses.
Yeah.
House usually is paid off or is getting close to being paid off,
Yep.
and they're not paying for their kids anymore, which is
Right.
a big expense for a lot
Yeah.
of people.
And that allows people to do a catch up. And we've all seen the studies, though, that if you save from 20 to 30 and then didn't save again versus the guy that saves from 50 to 60, the same amount, it's amazing how much more money you'd have. And so, great idea to save for retirement before you have kids. That's a winner. But yeah, once you get into the situation where, you're kind of deciding, you do have that possibility of kind of a catch up, right? Sort of depends on what age you are when your kids are born, right? I mean, whether you have that gap. But a majority of people save a majority of their retirement assets from 55 to 65. Just like Ethan said, that's when you have the most money, your peak earnings in your career, maybe your house is paid off or it's at least more manageable. Your kids might be out of college at that point in time, and you're really motivated at that point. And I'm heading for retirement and I got to save. So, ignoring your college costs, making your kids go someplace that's lower than they might have been able to go. I don't know. I'm not an advocate of that personally. I think you should take care of the kids. But hedge your bets because they may not go to college, right? So if you're putting everything locked up in a 529, that's a little bit difficult to get out without a penalty, and they don't go to college, that's kind of that's a problem too. All right, good. Well, that's excellent. Sorry for the start. We tried something new today with kind of this waiting room thing, and somehow I messed it up someplace. So anyway, really appreciate everybody joining us today. Look forward to seeing you again next Friday. And again, we will take pieces of this and put it on our channel. So if you just want to watch, the answer to kind of one question in one area, we'll be able to do that too. So thank you for joining us, and I will talk to you next week.